If you are over 40 and every dollar you have saved sits in an account with only your name on it, you need to hear this before something happens that you cannot undo. Most people believe that keeping their savings under their own name is the safest possible choice. It feels responsible. It feels controlled. But here is what nobody tells you until it is too late. The moment something happens to you, a stroke, a hospitalization, a sudden passing, that single name account gets frozen. Not eventually. Immediately. Your spouse cannot touch it. Your children cannot touch it. The bank locks the door and hands the key to a court process that can take months and sometimes longer. Stay with me for the next few minutes because I am going to walk you through 4 simple changes that take less than an afternoon and can save your family from that exact nightmare. None of these require a lawyer. None of these require you to give up a single dollar of control while you are alive and well. And by the time we get to the end, you will understand exactly why financial planners, they quietly recommend every one of these steps to their own clients long before retirement ever becomes a conversation about wills and estates. Why a single name on an account becomes a trap. Here is the part that catches people off guard. Banks do not care about your good intentions or your handwritten notes about who should get what. They follow strict rules. When an account has only one name on it, and that person becomes incapacitated or passes away, the funds are treated as part of an estate. An estate has to go through a legal validation process before anyone can access it. Even a spouse of 40 years may need to prove their right to that money in front of a judge. Even a child who has power of attorney paperwork may find that paperwork stops working the moment a parent passes because power of attorney only applies while someone is alive. This is not rare. This is the default outcome for millions of families every single year, and most of them had no idea it was coming until they were standing in a bank lobby, being told to come back with a court order. The first fix that changes everything. The first and simplest solution is a joint account with rights of survivorship. This is different from just adding a name to your account as an afterthought. When you set this up correctly at the bank, both account holders have full and equal access while both are alive and healthy. Nothing changes about your day-to-day control. You still use the account exactly as you always have. But the moment one person passes away, ownership transfers automatically and instantly to the surviving person. No court, no waiting period, no estate process. Just an ID and a death certificate at the counter. This single change is one of the most common recommendations from financial planners for married couples heading into retirement because it protects the surviving spouse from being locked out of the very money they need to cover funeral costs and daily bills in the hardest weeks of their life. But wait, because this next one might matter even more for your children. The tool most people have never even heard of here is something that surprises almost everyone I talk to about this. There is a bank designation called payable on death, sometimes labeled as a transfer on death beneficiary. This is not a will. This is not a trust. It is a simple form you fill out directly with your bank that costs nothing and takes about 10 minutes. You name a beneficiary, such as your son or your daughter. While you are alive, that person has zero access and zero visibility into your account. They cannot see the balance. They cannot withdraw a cent. You remain in complete control, exactly as you are right now. The moment you pass away, everything changes instantly for them. Your named beneficiary walks into the bank with your death certificate and their own identification, and the funds release directly to them within not months, days. No probate court, no waiting for other relatives to sign off. This is one of the most underused tools in personal finance, and it exists at almost every major bank in the country, completely free of charge. The emergency access. Most families forget until it is too late. Now here is a scenario people rarely plan for. What happens if you do not pass away, but instead become unable to manage your own finances due to illness or injury? This is where a durable power of attorney becomes essential. This document allows someone you trust to step in and manage your accounts, pay your bills, and handle your finances while you are alive, but unable to do it yourself. Without this document in place, your family may be forced into a guardianship proceeding through the court just to pay your electric bill or your mortgage while you recover. A guardianship proceeding can take weeks to establish and often comes with attorney fees that eat into the very money your family is trying to protect. Setting up power of attorney with your bank ahead of time costs almost nothing and prevents one of the most stressful and expensive legal processes a family can go through. The piece of paper that saves everyone. Weeks of searching. Let me tell you about the quiet disaster that happens even when families do everything right on paper. A parent passes away, and the children discover they have no idea how many bank accounts existed. They do not know which banks. They do not know if there were online-only accounts with no physical statements ever mailed to the house. They spend weeks contacting bank after bank, sending death certificates over and over, hoping to stumble onto forgotten money. This is completely avoidable. Take 15 minutes and write down every account you hold the bank name and the approximate balance. You do not need to write down passwords or anything sensitive. Just enough information so your family knows where to look. Put that paper somewhere safe and tell one trusted person exactly where it is. This single sheet of paper has saved families more time and money than almost any other single action on this list, because it turns a blind search into a 5-minute phone call. Why spreading your money around actually protects you? Here is a detail that even financially savvy people overlook. In the United States, deposits at a single bank are insured up to $250,000 per depositor through the Federal Deposit Insurance Corporation. In Canada, the equivalent protection through the Canada Deposit Insurance Corporation covers up to $100,000 per insured category at each member institution. If your savings exceed these limits at one single bank, the amount above that threshold is not protected if something happens to the bank itself. Spreading larger sums across more than one institution or across different account categories is not about distrust. It is about making sure every single dollar you have worked your entire life to save is fully covered no matter what happens. Combine this with beneficiary designations at each institution, and you have built a system with no single point of failure. What doing nothing actually costs your family. I want you to really sit with this for a moment, because the cost of doing nothing is rarely talked about in real numbers. When an account gets frozen and has to pass through the court validation process, families are often looking at legal fees that range from a few $100s for a simple case to several $1,000s for anything more complicated. On top of the money, there is the time. Weeks turn into months. Meanwhile, bills still need to be paid. A mortgage does not pause because a bank account is frozen. A funeral home still expects payment. Families end up borrowing money or draining other accounts just to cover costs while they wait for access to funds that were sitting right there the entire time. The four changes we are walking through today cost nothing and take an afternoon. The alternative costs real money and real time during the exact moment your family has the least capacity to deal with either one. Some of you are thinking, does this mean I do not need a will anymore? And the answer is no. You still need one. A will is where you state your final wishes for anything not already covered by account titling and beneficiary designations, personal belongings, property that is not jointly owned, and any instructions for guardianship of dependents still belong in a will. Think of the account changes we just covered as the fast lane for your liquid savings, and the will as the complete map for everything else. They work together. One does not replace the other, and having both means there is no gap for confusion or conflict within your family. If you take nothing else away from the next few minutes, take this. Call your bank this week and ask 2 questions. Can you add rights of survivorship to my joint account? And can you add a payable on death beneficiary to my accounts? Both of these take one visit, and neither one costs you anything. This one afternoon of paperwork is the difference between your family handling things with dignity and calm in the hardest week of their life, or spending months stuck in a courthouse hallway, waiting for permission to access money that was always meant to be theirs. Protecting your family does not require complicated legal maneuvering. It requires knowing these 4 tools exist and actually using them before you need them.